Hey there, real estate investors. Are you selling an investment property but worried about paying capital gains taxes? What if I told you there's a way to defer those taxes indefinitely and reinvest 100% of your profits into another property? I'm Andrew with Blu Hat Bookkeeping, and today I'm breaking down the 1031 exchange, a powerful tax deferral strategy that smart investors use to build wealth without giving Uncle Sam a big chunk of their gains. Stick around to the end, and I'll share key tips to avoid costly mistakes that could disqualify your exchange. What is a 1031 exchange? A 1031 exchange, named after Section 1031 of the IRS tax code, lets you sell an investment property and reinvest the proceeds into another like-kind property while deferring capital gains taxes. That means no immediate tax hit. Your money keeps working for you instead of getting taxed right away. But there are strict IRS rules to follow, and missing a deadline can cost you big time. The 1031 exchange process step by step. Step 1. Sell your property, the relinquished property. The process starts when you sell an investment property. You cannot touch the sales proceeds. They must go straight to a qualified intermediary, a neutral third party who holds the funds for you. Step 2. Identify a replacement property 45-day rule. Once you sell, the clock starts ticking. You have 45 days to identify potential replacement properties. The IRS allows 3 different identification methods. 1. 3-property rule, name up to 3 properties, and you can buy any one of them. 2. 200% rule, name as many properties as you want, as long as their combined value doesn't exceed 200% of your sold property's value. 3. 95% rule, you can identify any number of properties, but must buy at least 95% of their combined value. Step 3. Buy a new property, the replacement property 180-day rule. Next, you have 180 days from the sale date to close on your replacement property. The purchase must be equal to or greater in value to fully defer taxes. If it's less, you pay taxes on the difference, called boot. Step 4. Qualified intermediary transfers funds. When you close, your qualified intermediary transfers the funds directly to the seller of the new property. You never touch the money. If you do, it's taxable. What qualifies as a like-kind property? Single-family rentals, apartment buildings, commercial real estate, industrial warehouses, vacant land, retail stores. The IRS says the replacement property must be like-kind, but don't worry, it's very flexible. You can exchange a rental property for a commercial building or even vacant land. However, personal residences and fix and flips don't qualify because they're not considered investment properties. The biggest 1031 exchange mistakes to avoid. Missing the 45-day and 180-day deadlines, strict IRS rules, no extensions. Touching the money funds must go through a qualified intermediary. Not reinvesting the full amount, you'll owe taxes on any difference boot. Using the wrong property type, personal homes and flips don't qualify. If you mess up any of these steps, the IRS disqualifies your exchange and you'll owe capital gains tax immediately. That's why working with professionals like a CPA and a qualified intermediary is crucial. Now you know how a 1031 exchange can help you defer capital gains taxes and grow your real estate portfolio like a pro. Before you make a move, talk to a 1031 exchange specialist and a CPA to ensure you follow IRS rules correctly. If you found this video helpful, hit that like button, subscribe, and turn on notifications so you never miss out on smart tax saving strategies. And if you need help keeping your books in order for real estate tax planning, reach out to us at Blu Hat Bookkeeping. We help investors just like you stay compliant and profitable.